Investors have a lot to be thankful for as stocks rolled to all-time highs just before the Thanksgiving holiday here in the United States. Much of the enthusiasm was around positive economic reports, including GDP and durable goods. We also saw some of the FANG stocks start to come back to life, and 10 out of 11 sectors were higher today, with discretionary stocks leading the way. So we'll talk about all of that, and then we'll get into our trade application example on a fintech type of a company that's starting to make a little bit of a rebound. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 27th, 2019. First off, if you're new, welcome aboard. Remember to go to YouTube, click subscribe on our channel, and then check out our description area where you can sign up for our email distribution list. Remember, we're going to be sending out some Black Friday deals, so make sure you're signed up if you want to see what sort of offers we have here coming up this weekend. Also, we have a presence on Twitter. Feel free to follow me. My handle is @BrandonVanZee, and I do appreciate those of you that click like and retweet on these Market Outlook related tweets. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. This will give us a lay of the land with the four major U.S. equity indices. And as I mentioned in yesterday's presentation, we have these nice new high flags popping up on all four of our charts. So notice that we've got the yearly high there, the yearly high there, the yearly high there, and the yearly high there. Now, to take it a step further, remember that with the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite, we are at new all-time highs, not just yearly highs. With the Russell 2000, we're not quite to all-time highs yet, but hitting a 52-week high is certainly a change of sentiment there, as that had been kind of a lagging index for quite some time, and then all of a sudden with that shot in the arm that we got with small caps there on Monday, it looks like they are starting to play a little bit of catch up to some of the other indices out there. So strong momentum across the board, closing at all-time highs on 3 out of the 4 charts, and then closing at a 52-week high on that 4th chart there. Let's go ahead and take a look at our 3 green arrows chart, and this will be chart 4D for those of you that are premium market scholars following along at home. Remember, one of the benefits that you have when you sign up to become a premium member of Market Scholars is you get access to 50 different customized charts that David and I use, not only in these Market Outlook presentations, but in our individual trading rooms that we teach every day. All right, so as we look at chart 4D here, this is our 3 green arrows setup. I mentioned yesterday we just had 1 out of the 4 charts with 3 green arrows. Today we tacked on a couple of additional ones in the form of the S&P 500 and the NASDAQ Composite. You'll notice that both of those were able to capture a 3 green arrow signal when their MACD histogram produced a green arrow there to join the other signals. So at this point, the Dow Jones is the only one that does not have a 3 green arrow signal, and that one could come as early as Friday. Remember, stock market's not open tomorrow, but it is open for about a half a day on Friday. And so on Friday, if we have another tick higher in the market, the Dow could easily join the other indices with 3 green arrows there. And wanted to point out that the NASDAQ was actually the leading index here today. You'll notice that it's up 0.66% today, so a very strong day there. You heard me mention in the intro that the FANG stocks all of a sudden have come back to life as well. So I wanted to point that out as well. Let me right click on this chart and go to maximize the sell. And one thing that some folks are not aware of when it comes to the Thinkorswim platform is that you can actually put all of the FANG stocks on one single chart. You can do this for any securities really, but the FANG stocks are pretty well known. And so one way to go about that process would be to type in your ticker box up here, FB plus AMZN plus NFLX plus GOOGL. And then hit enter, and this chart right here will actually be the chart of FANG. You can kind of see that up here above the chart. It says Facebook plus Amazon plus Netflix plus Google. And as you can see, this is a very strong bounce off of that rising moving average for those 4 securities that growth momentum types of traders have found success with in previous times. And so, it's good to see them kind of coming back to life, because there was a moment in time in 2019 where they were kind of being pushed aside for other more exciting names, but all of a sudden it seems like FANG is back going into the end of the year. And as you can see here, hitting new multi-month highs off of a very nice bounce off of the 30-day moving average right there. And of course, FANG itself has 3 green arrows as of this moment in time. All right, let's go ahead and now take a look at our longer term view. And this is our 1040 crossover method. This is chart 4C here. Main thing to point out is that we do have the bullish crossover on the 10-week versus the 40-week moving average on all 4 of our charts. Remember, we try to make that nice and easy for your eye. All you have to do is ask yourself what's the most recent color background you see on each of the charts. And in this case, they're all green, meaning that we have that more sensitive 10-week moving average up and above the less sensitive 40-week moving average. And that's generally considered a positive sign for risk appetite in the markets. All right, let's go ahead and now take a look at our 12 grid analysis, starting with chart 5A. And as you can see here, these charts are starting to populate. Remember that this is the asset class 12 grid, and so this is not going to be stock specific here. This is going to be all different types of asset classes. And so you're going to have a mix of green and pink backgrounds. As a reminder, when we're looking at the 12 grid analysis, the green backgrounds signify bullish posture according to the market forecast intermediate term line. And then if you have a pink background, that signifies bearish posture on the market forecast intermediate line. So as you can see, we have mostly green charts here, which are telling us that it's not just the stock market that's strong right now. We're seeing strength in multiple areas. And so I guess the 3 pink charts that we have remaining are EEM, which is the emerging markets. We have gold down there on that bottom rung, and we have TNX, which is treasury yields on that bottom rung as well. Note that the 2 on the bottom have that darker shade of pink, telling us that they are strongly bearish postures, whereas emerging market stocks just have a weakly bearish posture there. Its intermediate line is at 58 and falling, so it's kind of in the middle of the range. It's not an extreme mover at this point. And just like I mentioned here yesterday, this stock, or in this case, this ETF, remains above a rising moving average. So I don't think we're to the point of counting emerging markets down and out permanently at this point. It's possible they're just trying to catch their breath and get ready for their next run into the end of the year, like so many other stocks are doing right now. But as you can see, most of the other charts are holding up reasonably well. The stock-related charts up there in the upper left are probably your strongest from a trending perspective, but it is worth noting that real estate had another fairly decent-sized day here today. VNQ is what we use to track real estate. It was up about 0.5% today, and you'll recall yesterday I mentioned this really big candle right here as kind of standing out like a sore thumb. Now yesterday it was a little bit more precarious because we ended just a hair below that falling moving average. With today's move up by another 0.5%, we are now above that rising moving average. Now, note, we are very close to a prior resistance area there from a horizontal perspective, where VNQ did kind of top out the last time around back on November 19th. So we're not out of the woods yet, but it's certainly more constructive price action that we've seen there out of the REITs. And they're trying to hold the line and carry their weight in terms of a sector perspective. Speaking of sectors, if we come over here and take a look at the sector 12 grid, this is chart 5C now that we're looking at. We only have 2 charts on the board that continue to be bearish. Those are your 2 in the lower right-hand corner. That's the utilities and real estate. And I remember with this particular 12 grid, the real estate we're using here is XLRE. So it's slightly different than VNQ, but they're both, kind of giving us the same types of signals, I suppose you could say. So right now, this is a market that prefers a bit more cyclicality, a bit more economic sensitivity as far as what it is chasing right now. And those more defensive areas of the market aren't quite doing as well out there. Although I will point out that these trades or these charts are all up except for real estate. Real estate is the only one over the last 3 months that is down. And as you can see, kind of I'm circling it with my mouse in the lower right-hand corner here, it's only down 0.03%. So in other words, you could call that flat. So if you've been invested in the stock market for the last 3 months, you should be making money at this point. You'd have a hard time not making money if you had a reasonably diversified portfolio, because all of these sectors are showing flat to positive gains across the board. And of course, the S&P 500 has been bullish according to the market forecast technical indicator, which is what we teach to in this particular presentation, for the majority of that 3-month period there. So anyway, again, investors have a lot to be thankful for this year. It's turning out to be quite the strong performance in the stock market. Also, let's come on over here to the internet briefly. Oh, and before I do, I was just gathering up some information for my swing trading class. I taught my factor-based swing trading class earlier today. Remember, that's one of our premium classes that we have here at Market Scholars, where we try to give you our best trade ideas. And one of the unique aspects of the classes that I teach is that I bring the trade ideas to the class, several of them, and then the class votes on what they deem to be the best setup of the ones that I've kind of pre-selected. And so we kind of consider it to be more of a collective intelligence gathering process. Sometimes that process works, sometimes it doesn't, just like anything in the world of the financial markets. But we've done really well this year for this swing trading class. The approach that we take in this particular class is an active trading approach, and we use a 1-for-1 reward risk ratio. In other words, if we're taking $1 worth of risk, we need to have at least $1 worth of reward possibilities as well. When you use a 1-for-1 reward risk relationship, you typically are going to have a win rate of about 50%. It's basically a coin flip. You know, if you got into a stock when it was trading at 50 with the hopes of getting out at 51 and you put your stop loss at 49, you know, some of the times that's going to go, you know, up and take you out at your price target. The other times it might go down and stop you out. So the point is, you should have about a 50% win rate. This class has done really well in 2019. As I was tallying up all of our trades, our win rate is currently sitting at 70%. Now, obviously, we still have one more month to go in 2019, so hopefully I'm not shooting myself in the foot by talking about it here. You know how that goes sometimes. But as of right now, we have a 70% win rate on our various swing trades for that particular class. So if you are somebody that is struggling with swing trading and you need some guidance, some assistance, you know, we don't give you direct recommendations. That's not our job. We're educators. But if you need somebody to assist you with your understanding of the markets and give you interesting trade setups to look at, I would encourage you to sign up for our premium subscriptions that we have here at Market Scholars. And again, those of you that are on our email distribution list, you'll probably be seeing an email from us on Black Friday with some sales that are coming out. So make sure you check that out if you're interested in taking your trading to the next level. But great job there to all the swing traders that attend my factor-based swing trading class. You guys are really knocking the cover off the ball with your win rate this year. Also, while I'm over here on the internet, wanted to say thank you to those of you that click like for me on these market outlook related tweets that I have out there. Remember, we try to make that nice and easy for you by posting the tweet in 4 different areas. One of the most convenient ways is for those of you that watch these videos right here directly on our website. Remember, David and I will put the link to the tweet itself directly below it, and 95 of you did that for me yesterday. I really appreciate that. I normally like to get that up and over 100, but I certainly understand it's a little bit different this week with us having maybe a thinner audience due to the Thanksgiving holiday coming up. I know a lot of people are out on the roads and in airports and traveling all over the country, so stay safe out there. I know we're getting a nice shot of snow here out in the Mountain West, so it's going to be a white holiday for us tomorrow, but we're going to stay indoors and enjoy some football and some food and family and fellowship all across the board. Hope you can have a little bit of that in your holiday tomorrow as well. So again, thank you to those of you that click like for us. It helps us spread the word about Market Scholars to a wider audience than we'd be able to on our own. All right, let's get back on over here to our charts and finish up a little bit of our 12 grid analysis before we get into our trade application here for the day. Let's go ahead and take a look here at, we did some of the country indices yesterday, so let's kind of skip over those here today and see what we can learn over here in the commodities 12 grid and see if anything's cooking from that perspective. So couple of things stand out to me. First off, it does look like the commodities index in general is trending higher. Notice that this chart in the upper left-hand corner, this is DBC that we're using here, so you can kind of use that as your general gauge to what commodities are doing, because it's going to have a basket of a variety of commodities within that particular product there. And as you can see, it is trending higher, a rising 30-day moving average with a bullish posture on DBC. Of the charts that are green, I would say that the ones that stand out as being maybe a little bit stronger would be gasoline that we see in the upper right-hand corner here. Of course, a lot of people traveling on the roads this weekend and probably soaking up some of that demand for gasoline, at least here in the United States. We also see copper had a very nice day yesterday. It was up a little bit more today, but the point is it bounced off of that rising moving average there. That's probably a strong sign. And then coffee has been strong for the last couple of weeks at this point. And so this is nothing new, but it's more of a continuation move there with coffee in kind of the lower right-hand corner of the chart. In terms of the commodities that are doing more poorly, I would say that natural gas doesn't look all that healthy in that top rung right there. And then you can also see in the bottom rung, corn is not looking all that healthy. Although I would point out corn appears to have an oversold cluster signal as of this moment in time, and it does appear to be lining up with a prior level of horizontal support over here from early September. So it wouldn't be entirely surprising to see corn bounce in the next week or two if it can find a little bit of stability in this area here. So we'll keep our eye on that one. Let's also come on over here, and while we're at it, take a peek here at our ratio charts. This will be chart 5Q. Now, as a reminder, when we're looking at these ratio charts, you're basically comparing one security to another security. Let's just use, how about stocks versus bonds here, kind of in the middle where I'm circling with my mouse. You can see the label in here says stocks divided by bonds. And so when you see the chart go from the lower left to the upper right, it's effectively telling you that right now stocks are outperforming bonds. If you see a chart that looks different than that, let's use emerging markets versus developed foreign markets as that example. This chart in the upper right, kind of in the purple there, where you have it largely going from the upper left to the lower right. That basically means that emerging market stocks are underperforming developed market stocks. So that's kind of that theme that I've been talking about here in recent presentations when we were looking at EEM and EFA on individual charts. When you combine those together, you get to see that philosophy play out a little bit more. When we were looking at the charts before, if we come back on over here and pop in the asset classes 12 grid again, just briefly over here at 5A, and you look at EFA right here, and you look at EEM right here. So this is the developed foreign stocks. This is the emerging foreign stocks. Both of those charts look like they're in uptrends. Right? What was catching our eye here in recent presentations was merely that EEM had gone to a bearish posture. But if you just ask the average person on the street without having any context here or understanding the color schemes or anything like that, they would probably look at both of these charts and say, yeah, they're about equally as strong. And so that's where that chart 5Q can help those of you that are premium members. It's a ratio chart to actually tell you very quickly which of those securities is actually outperforming the other. And so in this case, we can see that indeed it is EFA that is beating EEM, or if you want to think about it differently, EEM is losing to EFA because that chart is pointing downward. Other charts that have fairly significant trends right now, I would point out stocks to gold. Gold has been struggling here recently, and that wasn't the case earlier in 2019, but right now they've kind of taken a back seat, and people have not really been talking about gold all that much. Instead, the trader has kind of moved along to the stock market, and that's a crystal clear trend right there where stocks are being much preferred over gold at this particular juncture. So anyway, looks like stocks are the place to be, at least in the trader's mindset. And of course, that's exactly what David and I have been referencing in these videos for quite some time with this bullish posture we've seen on the S&P 500, according to the market forecast, and that is what we anticipate will continue into the year end. So we'll see if that happens or not. But right now, we are set within very strong trends in the market, which helps us place bullish trades. And speaking of which, let's go ahead and get into our trade application example now. And for this, I'm going to come on over here to chart. Let's do 3A for this. And this is a chart that emphasizes the near-term line on the market forecast more so than the intermediate line. Remember, the near-term line is the blue line. The intermediate line is the green line. So this particular chart is going to emphasize that more sensitive blue line for posture and positioning as opposed to the longer-term trend trader that typically would use that green line. So this is going to be a shorter-term mentality here, but I wanted to pull up ticker symbol V. This is Visa. And Visa has, as you can see here, been largely in a sideways type of a pattern for the last 3 months of this chart. You can see the last 3 days have been quite constructive in terms of, starting to play a little bit of catch up. And I say catch up because, as you can see, this chart is going to plot the S&P 500 on it at the same time that it plots the price candles of the underlying security, in this case Visa. And so you could say that over the last 3 months, Visa has underperformed the S&P 500. Now, for those of you that have followed Visa ever since it IPO'd, you might understand that that is actually quite a rare occurrence. If we take it a step further and show you, instead of a 3-month chart that we're looking at right now, and instead go to, let's say, a 10-year weekly candle, take a look at that chart. I mean, this is one of the most epic growth stocks that you're ever going to see, and it's not one of those hidden gems, right? You didn't have to uncover too many rocks. This was already one of the largest credit card companies on the planet 10 years ago. And what has it done? It's gone up by about 10 times in value over that time frame. Touched a low of about $16 back here in 2010 on a split adjusted basis, and put in a high of $187 here earlier this year. So from $16 to $187. The vast majority of that time, it has been a market beater. So that's what makes this last 3 months so peculiar. Normally, Visa is not a loser to the marketplace. This has been a rare exception to that. And so by getting into this now, you would be making a bet that it kind of clicks back into place, just like it has so often in the last 10 years, becoming a market outperformer yet again as we head into kind of the holiday shopping season. And of course, Black Friday is coming up here, where a lot of people are going to be getting their Visa credit cards out. We've got Small Business Saturday coming up on Saturday, and then if that's not enough, Cyber Monday next Monday. So a lot of people will be using their Visa credit cards here in the coming days, and of course that helps support Visa, the parent company, with all those transactions and fees that they get to charge as a result of the convenience they provide by allowing their network to be utilized worldwide. So what I thought we would do here today is a bull put spread. And so I'm going to come on over here to the trade tab. I've already got the trade established, so you can see what I've selected here. I'm using the January monthly contracts that have 51 days until expiration. Now remember, this trade's not going to go through tomorrow, so I'm going to put this in as good till cancel, just to be on the safe side. I know sometimes in paper money, things get a little bit wonky around the holidays. So I'm going to put that in as a good till cancel, just in case the system gets confused and thinks that the stock market's open tomorrow, which it's not. So this trade will go in on Friday morning when the market reopens. But what I'm selecting here is the $180 put in January to sell. So that's what that -1 means right there. And then at the same time, I'm combining it with $175 put to buy. That's what that plus means right there. The net effect of those two things is I receive a credit of $1.16. So I get money up front for selling this spread that I don't currently own. Now, how I profit off of this is by seeing Visa continue to be reasonably strong. I say reasonably because you don't need to hit a home run with this type of a trade. You could have the stock simply go sideways and you would make money off of this trade. Effectively, what you want to see happen after you have executed your trade is, in this case, for this $184 stock to stay above $180, which is the short strike in our bull put spread that we'd be selling here. Now, the reason we're buying a $175 put as part of this trade is kind of as a built-in hedge of sorts. It is there to protect us in case something really extraordinary would happen to Visa and it would just collapse in price. Let's say, it has a pre-announcement, an earnings pre-announcement or something along those lines that suggests that their future isn't as bright as people were thinking. And let's say the stock gaps down to $160 between now and January. I don't anticipate that, but anything is possible in the market. So if the stock were to open up one morning at $160, that $175 put is there to protect us. Now, we're still going to lose money on that trade. It's just that the further down below 175 it would go, we would be capping our loss potential by having our trade established this way. So this is a risk-defined trade. Now, we typically want to get at least a 30% return on risk when we're doing these types of credit spreads. And so in order to kind of calculate that, what you can do is click the confirm and send button once, and you'll notice our $116 credit coming into our account. But what I want to point your eyes towards is the max profit and the max loss right there. And if you divide those numbers into each other, so $116 of max loss divided by 384. I'm sorry, I said that wrong. $116 of max profit divided by the $384 of max loss means that we would get a 30.2% return on risk. So in other words, this is right over our yield hurdle of 30% return on risk right there. Okay, so we're going to go ahead and send that in, and we'll see if we can get filled on that first thing Friday morning. All right, again, thank you for joining me here tonight. Happy Thanksgiving. Thank you for your support. We appreciate your guys' audience and your loyalty to us here on YouTube over time. And of course, thank you to all of our premium members as well. It's been really fun to get to know so many of you. So tomorrow, no stock market, no video. David might be back with you on Friday for a little bit of a weekend wrap up, but hope you all have a great holiday and we'll look forward to seeing you all next week. Take care, everybody. Bye-bye.